Hello, everyone. Welcome to another episode of Bloom. I am, extremely excited about this next conversation because I've had a lot of people message me, particularly over the last year or two since I became a realtor, and talk about wanting to have discussions about credit and purchasing homes. And unfortunately, a lot of people may not have the information that they need or may be apprehensive about approaching a lender and asking questions. And so we wanted to do this discussion today and invite Lacy Dyar on. She works at a mortgage company, and she's going to answer any questions that anyone has about purchasing a home, whether you're purchasing your first, second, or third home. I tell people all the time, the only dumb question is the question not asked. So no matter where you are in your financial journey, please take this opportunity to speak with her. She's a wonderful person, both in and outside of work, and she is very transparent and has the spirit to help people. And so I want to invite Lacy onto the screen and invite her into the discussion. Hi, Lacy.
Hello.
How are you today?
I'm doing well. How are you?
I'm doing well. So quick story, everyone. Lacy is the woman that actually helped us purchase the home that we're in now. And it was such a wonderful, very smooth experience. And so I have stayed in contact with her over the years because she definitely knows what she's doing. She works for Supreme Lending and she's a program branch manager. And I believe you have a team of what, 5 or 7 people now?
5.
5, yes, a team of 5. But Lacy's the person that I can send a message to, email, text, if I have any questions about percentage of a down payment or whatever it is about a home. So I'm so excited that you could be here today. So thank you very much for being here.
Thank you for having me.
Yes, absolutely. So can you tell everyone a little bit about you?
Yeah. So I have, I'd said, and you put in the post that I have 11 years of experience in it's in the real estate realm in general, but I've worked for a realtor. I worked for a closing attorney for 3 years. Apologies for the cattail over here.
It's okay.
I knew it was coming. As soon as I started talking, she's going to show up. But I worked for a closing attorney for 3 years, and then I got into the mortgage world a little over 6 years ago. So I started doing loans. I worked under someone for 3 years as a loan officer assistant, and then I felt like I needed to spread my wings, and I started doing it on my own. But honestly, my mission is to serve. I love it when I'm helping people. I'm happiest when people are thankful for my service and I get to help them get into a situation where they didn't think they could be. You know, when you don't think you can buy a house and then we get you in a house, then it's the most rewarding thing ever. But personally, I live in the Huntsville area. I've been here for 20 years. So I call myself a Huntsville native. I've been here longer than I've not been here. I just turned 40. Sorry. And I've, yeah. It's only downhill from here, right?
No.
Skating, like it's easier. But yeah, I've been here for it's 21 years at this point. And I've always worked in the service industry. Every job I've ever had, my first job ever was tutoring kids in an underserved community, and it's just grown from there. So I love to help people, and really the most joy I get out of a loan is not your person that shows up with, a 780 credit score and $100,000 in the bank. Like, those are the easy ones. You just slam them through and they're done. But I love the ones where I get to work with people and help them. Thank you.
Yes.
When I get to work with people and help them get to the point where they want to be, like, that's my passion.
Yeah, I love that, Lacy, because, I'm sure obviously, this is your life's work, but there's so many people, life happens. So you lose your job, you get unemployed, and you fall behind on your bills, or you have a large amount of medical expenses and you just can't afford to pay your bills. And then your credit score, unfortunately dives down. And sometimes people are apprehensive or even scared to talk about their poor credit score with friends. And so I'm sure sometimes they're nervous about walking into your office, even though they don't need to be. And we'll talk about a lot of the things that Lacy does to help people rehabilitate their credit. But I'm so happy that everyone is here. And I just want to take a moment to welcome Kim Tammy Felicia, Debbie, Shayna. Thank you all for being here in the discussion. So feel free as we continue to move along to ask any questions that you may have. So you said that you've been in the field for 11 years. What sparked your interest initially?
Ooh, that's a bad story. Once upon a time, I married a realtor.
Oh,
I'm not married to that realtor anymore, but I married a realtor.
oh, okay.
It got me into the realm of real estate, and it was wonderful. I mean, just to see him, he had the same amount of passion though. Like, he just wanted to help people, and he worked his tail off. I would still say, even though he's not my husband anymore, he was one of the best realtors I've ever known, because he did not quit until the job was done. And that was, just seeing how much he worked with people and how much he helped people. And, you've always got your customers that you're frustrated with, or the ones that are just really hard to work with, but the good ones make up the difference for the bad. So being married to him, I actually worked for him for a little bit, and then he got my foot in the door with the closing attorney. So I worked for the closing attorney for 3 years and just did a lot of the coordinating things. And in that job, I bloomed.
Yes.
I got into a role where my job was being the face of that closing attorney's company and schmoozing the realtors, and going out and delivering goodie baskets and saying hi to everyone and making sure everybody knew who we were. So I got to know a lot of the realtors that I work with now as a lender, and they knew that I had the passion and the personality, I guess is the easiest way to put it, is just that I'm here to help. Tell me how I can help. So that's how I got into it. And honestly, when we split up, I wanted the farthest I could possibly be away from the real estate world, but I came back to it. After a little break, I came back to it and just said, you know what, I missed that. So it was good.
I love that you say that, because we talk about divorce and a lot of other situations that may not present themselves as a good situation initially. But like you said, and judging by you and your experience, that sometimes things like that happen to introduce you into something that's more so your calling. So I'm so glad that we have you and that it worked out, because I am grateful to be here in this house, and it has a lot to do with you. So let's dive into the discussion. So what is the difference for people who don't know between a mortgage company, which is Supreme Lending, who you partner with, and then a bank?
So banks are going to be your depository lenders. That's the technical term for them. That's where you put your money into a bank account. They will also have a mortgage branch. So you can walk into your bank and deposit money into your checking account, but you can also ask someone to do a mortgage for you, or you can open a commercial loan or open a business. But mortgage companies, which is what I work for, we only do residential mortgages. We don't do any commercial lending. We don't do any depositing. We're not going to help you with your financial advice or anything like that, except for to prepare you to buy a home or get a mortgage. So that's really the biggest difference. But on the dive deeper side, I guess it is, typically at a bank, and it's not always the case, but typically you're going to find banks want to work with your golden goose buyers, like that I talked about before, your great credit scores, money in the bank. They only want to do the easy loans. And we, at a mortgage company, we have a little bit more programs to get creative. We have your down payment assistance programs, your first time home buyer programs, things like that will help the more, I don't want to say more difficult, but yeah, the not so easy loans. We have the ability to make those happen.
Awesome. I love that. So can you talk to us about some of the important questions that people should ask, but maybe don't ask when they're actually purchasing a home? Like, are there any prepayment penalties, or any questions that maybe you would encourage people to ask when they're actually trying to find a lender?
Yeah, so the biggest thing that people typically want to shop for is going to be the rates and the fees. From lender to lender, they're always going to be a little different. But what is the best questions to ask, in my opinion, is when you first start talking to someone about a mortgage, you want to know, if I get your application and you've got a 620 credit score, I'm going to send you a loan example, and it's going to have a 4% interest rate, and it's going to have fees and stuff associated with it. But the next thing I would ask, if you've got a little time, if you've got 45 days, just say, hey, is there any way I could improve my credit a little bit to get a better rate? because that's almost always something that can be done that people don't know can be done. So they just think that they're playing the cards that they've been dealt, and they don't realize that they're, if you've got a little bit of extra money in the bank, you could pay down a loan some and get a better credit score within 15 to 30 days. And that could give you better terms.
Awesome. Okay, so I know people want to hear more about this in particular. So what's the typical credit score that you would like to see people have?
Hey, Sean.
Yeah, exactly.
Sean has entered the building. So our company will go down to a 580, and there's some companies that will go down to 520. But knowing upfront, let's say if you're below a 600, you will probably have to bring more of a down payment. And that's just standard across the board. There aren't that many companies that will go below 600 without at least a 5% down payment.
Okay.
Sometimes you can do 3.5% down on an FHA, but for the most part, we would like for your credit score to be above 620. You're going to get a little better terms there and not have to bring as much money down, and your rate is not going to cost you as much. And that's the big thing. And I know you wanted to talk about, like, what are discount points, and discount points are buying down your rate. So if with your current credit score, the best rate we can give you is 4%. Well, if you have an extra couple $1,000s, we could probably buy you down to a 3.5. But these are also things that a lot of lenders don't talk about. They spit out your standard loan example, and you never know what your options are.
Wow. See, that right there, that's great information to know. So if someone walks into your office and they have, let's say, a 580 credit score, and they want to increase their credit score, hopefully within the next 30 days, what are some things that they can do by partnering with you to help increase their score?
It differs.
And is there a fee associated with that as well?
No, there's no fee associated with that.
Okay.
That's when you close on your loan, you pay, I think it's $33.50 for your credit report, and that's it. So when we pull your credit, we will give you options and say, and it's different for every single person, that what would help their score improve. For some people, it's opening a new line of credit. And for some other people, it's paying down a credit card that's maxed out or close to maxed out. So it honestly differs with everyone. But to pull your credit, like for you to apply for a mortgage with me, you don't pay for anything until we close on your house. So if I pull your credit and I tell you, hey, you've got these 5 steps to take, and it's going to take you 6 months to get there, but we can get you to 700, then we'll just take the time and take the steps. And honestly, I wish she was here on this call. I had a couple that I worked with for 4 years, and that came with a lot of job loss, moving from Birmingham to Huntsville and renting a house in Huntsville. And over a 4-year period, we got their credit up and had enough money in the bank that they were able to close on a house. And that was their first house they'd ever bought. And they were like a married couple with 5 kids. So I loved that. That was one of my favorite ones. But it was great to see, I was in it for the long haul. Hey, we're going to get you in a house eventually. But every time we take a few steps forward, something would happen and we'd take a step back. So it was just a long, drawn out process, but it can happen for anyone.
Yeah, but I love that you didn't give up on them, which is amazing. And again, if anybody is watching that is in that current situation where they have a low credit score and they have just been through some stuff and you're apprehensive about reaching out to someone like Lacy, please do. I mean, honestly, there's so many programs out there that charge you a lot of money to help you repair your credit. To actually work with Lacy, and she doesn't charge a thing. I'm telling you, Lacy helped me and Sean purchase our home. So I've worked with her personally. Take advantage of it. I mean, honestly, just please do.
Well, and we don't judge either, because we see everything, and we're sometimes, if you're in the process of buying, an underwriter may ask you to write a letter of explanation, like, what happened in this situation? Why did you get behind on this payment? But just know that we're all human. I mean, when I was 19, I had a car repossessed. It happens.
Hello.
Right. No, I was not 19. I was 23. I had a, like I was very irresponsible with money. And I feel like a lot of my lessons I've learned the hard way. So I get it, and we're not always perfect. I see a couple of questions. Hang on.
Yeah, so let's go to the questions. Okay, so I see Kim said, I didn't know that you could buy down your rate. So wow, that was great information. I see Dante in here. He said, what credit score are you looking for a 3 to 4 unit residential property if it's your first investment?
Investment properties do have a minimum 680 credit score. So that is, and whether it's 1 unit or 4 units, you do have to have a 680 minimum. So, and those are 20 to 25% down minimum also. That's for investment properties though. And you used to be able to put 10 or 15% down and take a really high interest rate, and a lot of things have changed over the years, but I would say literally just through COVID, they've tightened down on their investment property guidelines. And it's not because of COVID. It's because of the housing boom. There are so many people that would love to buy their first home to actually live in it as a primary residence. So Fannie Mae and Freddie Mac, the people that control all the money for mortgage lending, tightened down on their restrictions for investment properties to allow more primary residence buyers to buy their first houses or buy new houses. So it's become harder for investment buyers to buy investment properties. And then let's see.
So you answered, do you only work with people in Alabama?
No. I am licensed in Alabama, Mississippi, Tennessee, and Georgia. I'm working on Florida, but I wanted to get just the states surrounding me so that I could help people. I do a lot in Tennessee because we're so close to Tennessee. I've never done a Mississippi mortgage, but I know that I have the ability to. And I've just closed my first one in Georgia about 6 months ago. So I cover a few states. Now there are some lenders, even some mortgage companies that all you have to do is have your license and hang it with that mortgage company, and they will cover you in all 50 states. But I just don't see there ever being a need for me to do a mortgage in Oklahoma. So the company that I've chosen to work with, I just need to be licensed in the states that I want to work.
Absolutely. That makes total sense. So
and
Debbie
differs from lender to lender too. So, you could go to someone that works at Prime Lending, for example. It's the one that comes up off the top of my head. But I know at Prime Lending, all you have to do is go work there, and they have a blanket mortgage license that covers all their lenders in all 50 states.
Oh, wow. Oh my goodness. I didn't know that either. Okay. So I also want to mention that Lacy she works for a mortgage company, but she's also an investor as well. So if you guys I see a lot of questions coming in about investment properties. Not only does she have the experience from working inside of a bank, she has the experience as an investor as well. So if you have any questions, even after this discussion, please don't hesitate to use her contact information that we're going to share with you after this discussion. So Debbie says, I have a co-op and I would like to refinance, but most banks don't want to touch cooperatives. Any advice?
Ooh, I don't know that I've ever worked with cooperatives. Tell you what, let's take a note and I will look into it and I'll get back to you. So I'm never going to try and, for lack of a better term, BS my way through an answer. If I don't know the answer, I'm going to tell you I don't know the answer and let me find out. So
yes, absolutely.
That's the best way to be. Honestly, it's worked so well for me because I'll do the homework and see what I can learn and then find out and come back to you.
Hey, that's honesty that I think everybody can appreciate. I want to also ask you, can you use a VA loan for the veterans that we have here in the discussion? Can you use a VA loan to purchase an investment property?
No, absolutely not. Only primary residences. And I see Tay. Sorry, another cat wanting to come in. I just say that does having a VA loan change those requirements and the guidelines for each specific loan, whether it be conventional, FHA, VA, or USDA, they're all different. So it honestly would depend. We would have to have a sidebar conversation about it to dive deeper into VAs. The VA credit score is going to be about the same. You will not have to put money down on a VA unless you're below 600, then you do have to put money down. So
Okay, awesome. So I see people are very happy that you can offer assistance in Georgia as well. So I think you need to
And
get in touch with
Mississippi
me.
too. I
Yeah,
see you.
yeah, Mississippi.
So
um,
Felicia, my specialty is actually VA. Out
mhm.
of all of the loans that I do, 60% is probably VA. And then the other 40% is spread between conventional FHA and USDA. I do a lot of USDA because we're in a rural area. There are some states like Florida, almost the entire state is ineligible for USDA loans, but you don't have to go very far out of the Huntsville area to qualify for a USDA loan. So that's it. And there's a map that you can pull up. I can actually provide that website if it's easier for people. But I can, I know kind of the guidelines. From the middle of Huntsville, if you go north of Meridianville, you're USDA eligible. And if you go east of the Flint River, say if you're in the 35811 to Newmarket area, anything east of the Flint River is probably USDA eligible. And then south of the Tennessee River, once you cross the Tennessee River, you're USDA eligible. And Athens is all USDA. So it's the ineligible area is pretty constricted to just Huntsville and Madison.
Okay, so can you tell everyone, for the ones that may not be aware, what's the difference between a VA loan and a USDA loan?
Not a whole lot other than with a VA,
Okay.
you've got to be a veteran.
Okay.
So the primary borrower must be a veteran. With a VA loan, I know one thing that a lot of people ask is there's not a down payment required unless you have a lower credit score. But with the VA, you will have what's called a guarantee or a funding fee. Sorry, with the
Hmm.
USDA, it's a guarantee fee. But they're literally the same thing. They are mortgage insurance. And so you hear about having PMI or mortgage insurance. And with conventional, it's going to be based on your credit score. With FHA, it's flat, it's set. With USDA, it's set. With VA, it is set depending on how many houses you've bought. So the first time you get the lower option, the next time anything, it's called a subsequent funding fee. It's a little bit higher. And then if you have 10% or greater disability, you have no funding fee. So they cut that out entirely. So there's no mortgage insurance for a VA with anyone with disability.
That is
That's
fantastic. That's great information. Honestly, it really is. It's
And
really
yes,
great
Sean, it
information.
has to be. VA only allows primary resident. VA, FHA, and USDA only allow primary residents. I see Shannon ask a question before it gets too far down on the screen and I miss it. I don't see this market changing anytime soon. And here's why. First of all, Huntsville is going to continue to grow. They're not going to stop growing for the next, what we know for sure, 6 years before all of the FBI is finished and Toyota Mazda is finished. And then the new, is it Space Force? I'm saying that right?
Space Force, yeah.
So all of the new ones coming, they're planned out to trickle in over the next 6 years. And I can imagine over the next 6 years that more big programs are going to bring more people in. So we're going to continue to grow. The market will not change very much unless we get more builders building more subdivisions. And I know there's a lot of, well, we should have put this on the bullet points. A lot of talk about there being a housing bubble.
Oh, yes. We can definitely go ahead and talk about that
Oh, yeah.
one.
Well, one thing I can say about the bubble idea is number one, it's totally farce. Absolutely. We are not in a housing bubble. The housing market is not in a bubble. Individual buyers who pay more than a house is worth put themselves in a bubble in that house. So it's not about there being the whole market is in a bubble and it's about to pop. It's the people that are paying $50,000 more than an appraised value for a house that they really, really want, and they come out of pocket $50,000 for it. Well, now they've got to wait for their value to catch up. So,
That makes sense.
3 to 5 years down the road, great. They're not going to be in a bubble anymore because their house is going to be worth more than they paid for it. But in the meantime, they need to stay in that house or else they're going to lose money if the market levels out. I just don't see it leveling out because it's all about demand. And right now there's so much demand for housing and there's not enough houses being built to keep up with the demand.
That is great information. I'm sure a lot of people will appreciate. Kim says Space Force is coming to Huntsville. Wow. Yes, it is. And the census was updated 2 weeks ago, and we're now the largest city in the state of Alabama. So,
Oh, yay. I didn't know that.
yes, we are so
I knew it was
excited
coming.
about that. Yep, they got to us early, so that was great information. So let's talk about, okay, let me see. Dante has a question. Say if you have a primary residence with a VA loan, and you decide to move out, can you refinance out of the VA and earn your loan cap back?
You can, but in some situations you may not need to. So the loan cap for a VA loan is 548,250. So if you own a house and it's $200,000 and you want to make that house an investment property, you can move out of that house and buy another house, keep your VA loan with the first one, have a VA loan on the second one because you're buying it as a primary residence. So that VA loan on the first one, just, I guess it converts to an investment because in terms, but you don't have to refinance it or anything or make it an investment property. But you can borrow up to, what did I say, 548,250. So you've got 348,250 left to buy your new house. So if you wanted an expensive house, yes, you do have to rent or you have to refinance from the VA to a conventional. And it would be best if you had enough equity to call it an investment property. So 80% equity at least, or 20% equity at least. But if you did that, then your entitlement is what it's called. Your entitlement is restored back to the full 541 or 548,250. I hope that is
No, I'm so glad you mentioned that though, because even us a while ago, we're veterans as well. We didn't realize, I think you said the entitlement is now 540,000. So we didn't realize initially that if you only purchase a house, for example, that's $300,000 and you decide to purchase another home, that you could still use the rest of that VA entitlement and then make up the difference. Is that correct? Right.
Yeah.
Okay.
You can use all of it. So anything above a total used amount of 548,250, you put 25% down.
Yeah.
So it doesn't mean you put 25% down on the entire loan, but if you, let's go math, 548,250 is your max. You've got a house for 200,000 and you want to buy a house that's 448,250, then you have to put 25% of that additional 100,000 down. So it's only the amount you go above the loan limit of 548,250, which is strange. That's only if you have more than one loan. So on a VA loan, there is no loan limit. So if you only own one house, you can buy, I just did a $1.2 million VA loan for some borrowers and they had no down payment. So you only have to deal with the loan cap if you already have used part of it and you're using the rest of it.
Wow, I didn't know that either.
Yeah, so you can have two VA loans as long as the two combined don't go over 548.
Got it. Okay, that's great.
Yeah.
Is everyone getting this? I know this is great information. we're gonna have all this entire website is going to be this entire discussion. Excuse me, is going to be on our website. So if you need to rewind and watch this again, you can play it back as well. And then of course we'll include Lacy's information so you can contact her directly if you have any specific questions. So I want to talk a little bit about the type of loans that you offer. So you offer like renovation loans and things like that, and bond loans. Can you talk to us a little bit about that and the purpose and the intent?
Yeah, I think the most sought after ones are going to be the bond loans, and that's for your first time. They don't have to be first time home buyers, so I'm not going to say that specifically, but that's your down payment assistance loans. They're also known as bond loans. With that, it's an FHA loan. You have on an FHA loan, your minimum down payment is 3.5%. So you can get a second loan to borrow that 3.5%, or even in some cases, you can borrow 5% for your second and then use some of that for your closing costs. But then I think we have 8 different bond loan programs. So some of them, the second loan is forgivable. If you live in the house for 5 years, make your primary payment on time, then that second loan just poof goes away and it's forgiven completely. We have another program that it's forgiven in 3 years, but there are different qualifications for it. And it's all income-based, credit score-based. So it's different for everyone. And that's why I say there's no way I can cover all the bases, but with these programs, you don't have to come out of pocket for a down payment and all of your closing costs. maybe some of your closing costs, but not all of them. But it would just differ for each individual person based on their income and their credit and how much money they have, whether or not they would qualify for one specific one or another one. Then on the renovation loans, the way those work is if you find a house you like, but it needs a lot of work. It's easy math level. If it's not for fix and flips, these have to be for primary residences, to answer your question real quick. But for a renovation loan on a primary residence, you can borrow the money to do the renovations. The way that works, if you go under contract for a house for $100,000 and you want to put $50,000 of work into it, before you ever even write a contract on that house, you need to have a contractor give you a quote and tell you how much the work is going to be. That way, if you have a quote for $50,000 and a contract for $100,000, then we send both of those to the appraiser, and the appraiser says, well, if this work is done on this house, then it will appraise for more than $150,000. Then we cover the renovations for you. Not cover as in pay for it, but we will finance that for you. Renovation loans are a little bit tricky because with the workforce being the way it is right now, I don't know if any of you have tried to reach out to a contractor and get a quote for anything. We just paved our driveway. We built a house in the middle of nowhere and we didn't pave our driveway at first. So 2 years later, we paved our driveway and we had to reach out to 7 concrete contractors before we got out of those 7. 2 of them actually showed up for their scheduled appointment. One of them actually gave us a quote. The other one never even sent a quote. So we went with the one that responded. But that's the hard thing about renovation loans is you have to have licensed, bonded, insured contractors. You can't do the work yourself. Someone else has to do it. And getting a contractor nailed down is like nailing Jell-O to the wall right now. So it's really difficult, but if you're willing to put in the time, it can happen. We've done a couple of them recently. What else did we say we offer? Manufactured homes. So if you live out in the country and you found a lot with 5 acres on it and it has a double wide manufactured home, we offer loans for those. There are a couple of stigmas. The manufactured home cannot be so old. I think it's got to be built since 1990. And then it has to be permanently affixed to the foundation. If it's still got the wheels and the trailer hitch on it, not happening. Absolutely not. So there are a couple of little stipulations there that we have to stick to. And each one of those, like I keep saying, just reach out to me and ask. I can cover everything in a lot more detail.
Absolutely. Please definitely do that. And what about bank statement loans? Do you all offer that as well?
We do. It's through a third party, but we offer bank statement loan programs for your self-employed borrowers that say if you make $100,000 a year, but you write off 80,000 of that, you only get to buy a house with the 20 that's left over. And that's not a lot of money every month. No. So we offer, and a lot of realtors do that. That's what we primarily kind of cater to for that. But we just, any business owner, your goal is to write off a lot of it so you don't pay a lot of taxes, but what you actually pay taxes on is the only amount that you get to use for qualifying income. So we can do bank statement loans where instead of getting your W-2s and tax returns or your 1099s and tax returns, we get 24 months of bank statements or 12 months of bank statements. And if your deposits qualify you, you're good. That's what we go by.
All right, entrepreneurs, you heard that. So definitely don't be afraid to purchase a home or investment property because Lacy can definitely help you with that as well. So can you talk to us also about people who actually own a home and they maybe are trying to find a creative way to either do renovations on their current home or purchase an investment property? Is HELOC a good option for that? And if so, can you talk to people about what that actually is?
Yeah. A HELOC is a home equity line of credit. So if you own your own home, and either you've been in it for a long time and your balance has gone down, or in current market, if you've been in it for 3 to 5 years and your value has gone so far up that you've got a ton of value in your home, you can borrow against the equity in your house. I don't do these loans. These will be done by a bank, but I do highly recommend those because you can pay off that home equity line of credit on your own time and keep it open. It's like a credit card that you pay it off, and then you have this cash available to you at any time if you want to start using that to buy investment properties. That's how we bought our first investment property, was with a HELOC on our primary residence. We took out the equity that we had after we built and used that to buy our first investment property. So then, we would close on our third investment property tomorrow, but we're thinking
Yes.
we did. So there are a couple different ways you can do that, though. You can either do a HELOC, which is reusable, or you can do a cash out refinance, where in that case, the interest rate's going to be lower. It's going to be for a longer term. A HELOC is literally used like a credit card. You're going to have a higher interest rate, but you can pay it off anytime you want to. If you do a cash out refinance on your home, then you're just taking money out of the equity, but you're refinancing your entire 30-year mortgage for a higher dollar amount. And you get a check written, and that's it. This is your new payment. This is your new structure. So they're going to have a lower interest rate, but it's stretched out over a much longer period of time, and you don't really get to pay it off and reuse it like you would a HELOC. Then we also offer the renovation loan that I just talked about. You can do that for a refinance as well. So if you want to refinance your current house on a renovation loan, then it would work exactly the same way. You call a couple of contractors, you say, I want new floors, cabinets, granite countertops, let's do all the things. Then as long as it's adding value to your property, it's no problem. And honestly, even when it's not adding a ton of value, we've done renovation loans for people to add a pool. And
oh, wow.
A pool will add sellability, but it does not add the amount of value that you put into it. It's like a really good pool with a pretty patio. It costs you 60, 70 grand, but you're probably going to get $10,000 or $12,000 in value on your house with that pool. So,
Sean, did you hear that? If you're listening, because he wants a pool.
Yeah.
Lacy said.
I just burst his bubble. Sorry. But yeah, there are three different ways to cash in on the equity of your house. And those are the three best options. Is either get a HELOC, and you can just use that cash whenever you feel like it. You can do the cash out refinance and also use the cash whenever you feel like it, but it's a 30-year mortgage, or the renovation loan where you have to do it with a licensed contractor, can't do any of the work yourself. They have to be licensed and insured to the lender's specifications.
Okay. That makes sense.
Mm-hmm.
I'm so glad that you're on here, offering this type of advice, because I don't know about a lot of people, but sometimes we are, like I said before, apprehensive to have these kind of discussions. So I'm grateful for Lacy for being here and answering questions for us. And I also want to encourage people, before we end this discussion, if you have any questions about how Supreme Lending and Lacy in specific can help you build your credit, please don't hesitate to put those kind of questions into the comment section. Because the worst thing that I believe that people can do is not ask the question that they need to ask to get to a better place. And people are genuinely here to help. And so Kim's asking a question. She said, are HELOCs available if you have a VA loan? Does that factor in, or is it something completely separate?
They are available as long as you have the equity in your house. The only drawback to a VA loan is that when you're borrowing 100% of the value, you don't build equity as quickly. So if you've been there for a little while, then you may have a ton of equity that you could take out a HELOC on. So yeah, it wouldn't affect your VA loan at all.
Awesome. I love that. So before we end this discussion, I want to double back to the credit conversation real quickly. What are some things that you all do to help people boost their credit score? What are your top 3 or 5 things that you really help your clients focus on to increase their score?
Number one thing, if I could offer any advice at all, is always make your minimum payments on everything every month on time, because nothing messes up your credit like a 30-day late payment. So even if you have, if you have a medical bill, you mentioned that, if you have a medical bill and you send them $25 a month, and I used to do it, you get a $900 bill for something that you didn't expect, just put a $25 check in the mail every month. They cannot report you to a credit bureau if you're paying them something. And typically $25 is the minimum. So I would say start doing that, because the farther you get away from any 30-day late payments, the more your score is going to increase. And I call that credit jail. If you have a 30-day late payment on something, there is nothing you can do to get out from under that hit to your credit except wait. And it's hard. It's hard to wait, you know.
Yeah.
In a lot of people's cases, I've got somebody I just worked with this weekend that they had a 30-day late payment in December, and it's going to be another 4 months before they get a credit score increase. But I have a system, I have a simulator that actually shows me that, you know, here's your credit report right now, and what's it going to look like with on-time payments in 2 months, 3 months, 4 months. And when I get to the 4-month mark and I see your score jump up, I know how long to tell you to wait. So the biggest thing is always make your payments on time, because credit jail sucks. And then if you have your credit cards, keep your balance at or below 25% of the limit. So if you're maxing out your credit cards, even if you pay them off every month in full, guilty. I have one credit card that all of my business expenses go on every month, and it's like $3,000 a month in business expenses. So by the time the end of the month comes and the statement is about to come out, my balance is way high. And then when I pay it off in full, when I get my expense reimbursement, then it's already reported to the credit bureau that I was almost maxed out on that credit card. So, and of course I'm doing it for the points because I get free money. I'm doing cashback rewards. So
Totally get it. Yep.
But in that case, they've already reported that my balance was high, and that dings my credit score every time. So I try and stay ahead of that and pay it off before the statement comes out, but it doesn't always work out that way. So in that case, you always want your balances to be lower. And Shayna she said, let me get those school loans handled.
Yes.
School loans are so hard. Student loans, here's a little known fact. If you've not bought a house in the past 4 years, now whatever your student loan balance is, whether you're deferred on an income-based repayment, in most cases, we have to count some kind of payment against you. So even though your credit report may show that you've got $80,000 in student loans, but you have zero payment, we have to count 1% of that payment against you, which is $800 a month. That's eating up your income.
Wow.
So yeah, so it shocks a lot of people when they come to me and they're ready to buy a house and they're like, I don't owe anything on my student loans. And I'm like, but you still owe that money back. So we have to count some payment. Now, some programs only require us to count 0.5%, which would be $400 on an $80,000 student loan. But that's still a big hit to your debt to income. So it does affect people more than they think.
That's great information. I want to address Tay says, does paying your bills on a credit card and paying the card off at the end of the month help build credit faster? Because I hear that you spend your money on, credit bureaus pay attention to that.
Yeah, it helps as long as you pay it off before that statement hits. Because if you're running up your balance before the statement hits, then they're reporting you. And just think of it like an end of the month thing. You want to have that paid down before the end of the month, because creditors have until the end of the month to report to the credit bureaus what your balances are. So that's why if I ever do a repull on somebody's credit, I'm going to wait till the 10th of the following month, because I want it to reflect everything that's been done over the past month. So yes, it can help you. I don't think they really pay attention to what you spend your money on. But utilization of a credit card is very important also. It's a double-edged sword, because we want you to have credit. You've got to have lines of credit open, and we want you to utilize that credit. So if you've got a gas card, you want to put $10 on it and you want to pay that $10 off every month. But if your limit is $300, we do not want your limit to be at $300 or your balance to be at $300. So you have to use it wisely. And it's a very fine line that you have to balance.
Absolutely. But like Lacy said, if you can at least pay $25 a month, preferably your minimum payment and then some, to make sure that you're keeping your credit utilization down. But if you can at least pay $25 a month to show them that you're willing to make a payment so you don't go in arrears, that would be amazing.
That would keep you out of collections.
Yeah, because I mean, if you go into collection, that stays in your credit report for what, 7 years?
Yes.
Yeah, 7 years. So that's a long time, and we want to make sure that everyone is able to purchase a home. And
Yeah.
so Tammy has. Oh, go ahead. You have something
I
to
was going
say?
to say, and it stays on your credit report for 7 years, and it affects your credit score for 2 years. If you have a $200 medical collection that's on your credit right now, you can pay it off today, and it's not going to improve your score for 2 years. They keep reporting negatively for 24 months. That's the credit jail I was talking about. They will keep reporting negative for 24 months. Now, after 12 months, it's better, but it's not going to stop affecting your score for 24 months.
Wow, wow. So if anybody is here that's in that current situation, I don't, neither one of us wants you to allow that to stop you and leave you at a standstill, because wherever you are now, if you work with Lacy, for example, to develop a plan for yourself, 2 years from now, you can be in a totally different place, and much happier with your credit score and your life in general, because this stuff, it really does affect you emotionally. So Tammy has a question. She said, would a HELOC be better to use to pay off a pool? I imagine the interest rate has to be better than what the loan is. Please tell me what it is. Please tell me it
Yes.
is.
And yeah, I actually have a friend that's doing that right now. She just took out a HELOC to pay off her pool loan, because the pool loan is like a 17% interest rate, and her HELOC that she just took out on her home is 7%. So it was a much better. Now it is still it's weird because it acts like a credit card. You get to use it and then pay it off, and the limit still stays there, so you can reuse it later, but it also reports as a mortgage. So it's a second mortgage on your home, essentially, but it does have a much better interest rate because it is a mortgage.
Okay, I'm sure that answers your question, Tammy. That was a great one, definitely.
Yeah, I would, if you have a pool loan with a pool company, I would recommend taking out a HELOC to pay off that pool loan and just paying the HELOC. Tay says, how many lines of credit do you recommend someone have? Most loan programs require 3. So car loan and 2 credit cards. And to that point, don't self-report. There's some Experian or somebody started saying a couple of years ago, oh yeah, we have this new program where you can self-report your cell phone bill, and if it's $200 a month, that'll help your credit. Well, then we have to count that against you for your debt to income because you're self-reporting it. Don't do that. And then don't, like Zakia said, please do not pay a credit repair company. They take your $179 a month and they work as slowly as possible to fix your credit. So they're taking your money every month and they're working at a snail's pace. And that's what you don't see. They're always like, oh yeah, we're working on that. But there are things that we can tell you to do for free that will help you much more. And then the lines of credit, if you have credit cards, it's always better to have a card with a Visa, MasterCard, Discover, Amex.
That's true.
Don't go get a store card. You don't want a Bath and Body Works credit card. It doesn't help credit. Or a lot of people finance furniture because that's a big deal, right? Or if you go to Lowe's and you have a Lowe's credit card, those are not as good as having a Visa, MasterCard, Discover, or Amex. So you want one of the 4 big names on it. Otherwise, it's not going to help you as much. It does still help. It still counts as a line of credit for buying a house, but those are I don't know why they're viewed differently from a mortgage standpoint.
Okay, that's good to know as well. I'm sure I love that everyone has so many great questions about credit score, because I've shared my credit story before too about I've had my car repossessed in my 20s. See, my son is about to come in here and say hi. You want to say hi? So yeah, so I've done all those things too, and yeah,
Hi.
say hi. And so, doing the right things to make sure you get things in order can definitely have a huge difference in what your credit score can become. So please, definitely, guys, we can definitely do this together. So Tay says, do you think it's a smart idea to ask for a larger credit limit to bring your utilization on your cards down?
That's the easiest way to get your utilization percentage down. I mean, you still have a balance that you owe them, so you're going to have to pay it eventually. But for a quick fix, absolutely.
Yeah. And can you tell people what's the difference between a soft pull and a hard pull?
Oh, that's a good one because I don't do soft pulls. Soft pulls are
Oh,
more
okay.
like and while we're on that topic, we can go over the different types of credit scores. So Credit Karma, there's your soft pull right there. Credit Karma is they don't give you a real score. They're giving you a generalized idea of the score that they think you might have based on the information they can pull for free online. If you go to Experian, Equifax, TransUnion, you can get a free credit. You can
Oh,
get
I
a
got
free
you.
credit report with your actual FICO 8 score. And a lot of people say, but my FICO score is different from the score that you pull as a mortgage company. Well,
Mm-hmm.
we pull a FICO 10. Nobody can pull a FICO 10 on their own. Mortgage companies can, and they're scored differently based on different criteria. So we're going to look at a foreclosure more harshly than Credit Karma will, or even Experience with their FICO score. What's funny is I told you I'm about to buy a house. Credit Karma says that my score is like 660, and that's probably because of my high utilization on my business credit card, or the fact that I have a couple mortgages.
You're so
But
busy helping everybody else.
yeah, my debt to income is whoop. But Experian, I have a credit card, Amazon Visa. So if you get an Amazon store card, that's going to be different from getting an Amazon Visa card. So you always want to opt for the Visa card option. So my Amazon Visa pulls my FICO and tells me it's like 680. Well, then I go to buy this house and my credit score is a 710. I was like, yes.
Yeah. Yep.
Great, because I was terrified I was going to get a terrible interest rate, but my mortgage score is different because I make responsible payments. My on-time payment history is great, at least for the past 2 years. And then I have utilization of several different lines of credit. I have a car, I have a couple mortgages, and then I make my payments on time, of course. So that's one thing I say, of course. I almost didn't a few months ago. I forgot to pay something. Thankfully, they called me and reminded me to make my payment. So y'all don't think that
Yeah,
this
that's
happens
good.
to nobody. Like even I'm a branch manager for a mortgage company, and I almost had a 30-day late on a mortgage, which would be terrible for me. But it's thankfully they called and they were like, "Are you okay? You haven't made your payment yet." So,
Yeah, that's
oops.
good.
But yeah, there's so many different moving parts for every situation that a lot of people don't know. Like they don't know that Credit Karma doesn't really give you your credit score. They just give you an idea. That's why they don't do a hard pull on your credit. Experian, Equifax, and TransUnion are the 3 bureaus that people report to, that creditors report to. So they may not do a hard pull on your credit because they've already got the information. And then a mortgage company is definitely a hard pull. Somebody mentioned buying a car. They said they had applied for a car. Yeah, Shayna
Yes.
applied for a car a few months ago. It stays on your credit report for, I believe it's a year. I don't quote me on that, but I know that the credit pull from applying for a car, they will shoot your information out to 10 different companies because they're trying to find, they're going to tell you that your interest rate on your car is 3%, but they shoot your stuff out to 10 different companies to get a better rate for them that you never know about. So that's why you
Oh,
get so many times, like they're trying so hard to get a better interest rate, not necessarily for you, but you get 10 credit hits and they're hard pulls and they will affect your score for 4 months. So
oh my goodness.
I know they stay on your credit report for a long time, but they only affect your score for 4 months.
Wow. I did not
Mhm.
know that either. Shayna, great question. I'm so glad
It's
that you asked that.
Yeah, it's really good to go to. So we're in Huntsville, and Redstone Federal Credit Union is like
Hmm.
where everybody banks. So it's good to go to your bank, Redstone, for example, and say, "Hey, I would like to buy a car. How much am I pre-qualified for?" They give you a letter for $20,000. Then you walk into the car dealership and say, "Hey, I want to spend $20,000 on a car." Or well, 15,000, I guess, because once they add their fees and everything on, it's probably higher.
Yeah.
But if you do that and tell them, "I do not want you to pull my credit," "Oh, but we can get you a better deal." Please don't pull my credit. You've already had it pulled from a lender that you trust. So let them go and or let your bank finance your car, not whoever they choose, because you could end up paying some company that doesn't even report to credit bureaus. That happens.
Wow, that's insane. Okay, so I want to get to Azura's comment. She said, what would you recommend for someone who doesn't have a ton of debt, but still can't even get approved for a credit card? Student loans definitely took a backseat in my younger years, but I've been paying them all on time for a year now. I have no credit cards, and the only large loan amount I have is my mortgage.
An excellent choice for that is to get a secured credit card. I should have mentioned this earlier. I'm so sorry. It's the best way to build credit. A secured card is you put your own money onto a credit card. So you could walk into your bank and say, here's $500 of my money. I would like a Visa credit card. And they will open you a credit card with your own money. That way the bank's not responsible for any of it. And you basically put your money on a credit card. No?
Really?
Oh.
Does it matter what the company?
That's what I was going to say. There is another company, and I believe I may have to look this one up too. Creditbuildercard.com. Let me look that up real quick. That's who I have sent a lot of people to for help. Like if they have a ton of bad debt or old collections that they've just been sitting there for years and years and years. If they need to build some kind of credit, they would, I've had people like a 490 or a 510 credit score. They would apply for this creditbuildercard.com. And it's really not an awesome option in the line of credit. Like I would have it for a year, build your score up, and then close it and be done.
Okay.
But I think theirs is a $300 that you have to put on the secured card. But what I like about them is they report weekly that you're up to date. Don't ever miss a payment with them because they will slam your credit if you miss a payment. So if you have a 30-day late with them, it's not pretty. But they report weekly the good part. So that'll help.
Awesome. Looks like that was great information for her. She said, thank you. It's only the student loans. I think that's the issue.
It takes a long time to rehabilitate from student loan. One of the big questions when you're filling out a mortgage application is, are you delinquent on any federal debt? And that includes student loans. So they really don't like delinquency on federal debt, and student loans are one of those. So if you are delinquent on student loans now, you can call the student loan company and ask them to get you in a rehab program, and they will set you up a new payment. And you make 6 months of on-time payments, and they will take you out of collections.
Awesome. Okay, and so I think the last question is probably going to be, what about a cosign? Will that help as well?
With a cosigner, that will help on a debt-to-income issue, but it does not help on a credit issue because we're always going to use the lowest score.
Awesome. Okay, great. This was awesome, guys. I hope you all got exactly what you needed out of this discussion. It was a lot of great, vulnerable conversations that were happening in the chat. And Lacy, you were amazing.
Thank you.
Answering all of these questions. Again, we're going to share Lacy's contact information in the chat in case you need to contact her directly. But before final question, is there any piece of advice that you want to leave to everyone, to our viewers today, that maybe you didn't get to cover earlier?
Really, the biggest thing is just to open yourself up to questions, because you don't know what you don't know when you don't know it. So it's so easy to be afraid of it and not ask the questions. But if you ask someone like, hey, could you just tell me what it would take for me to get a mortgage, or tell me where I am in the process, or, we're always open to, like I said, no judgment. We've seen everything, and most of us have been through it before. So it's so easy just to stick your head in the sand and hide from it, but always know. And it's very important to know where you stand. That way, if you ever need something, then you know how to get there.
Absolutely. That is fantastic advice. Do not delay the process by not opening your mouth and asking the questions, because there are so many people who are there to help you. And I can guarantee you, I work with Lacy directly. She is definitely here to help you. Lacy, you're amazing. Thank you so much for blooming with us today. And thank you to everyone who's joined us on this discussion. We have more amazing conversation coming up in the next upcoming weeks. So be sure to follow our page and stay tuned. I will let you all know when the video is published on our website. Have a great night, Lacy. Thank you again. I will talk to you soon.
Thank you for having me. Y'all have a great night.
You too. Bye.